this meeting of the Task Force on Homeowners and Property Insurance to order. A quorum is present. We have minutes from the previous meeting to approve. Is there anyone who would like to, assuming that nobody has any objections to the meetings, everybody's read them, do we have a motion to approve the minutes from the last meeting?
So moved.
Mr. Cocking moves that we approve the meeting minutes from the last meeting. Any discussion? If not, all those in favor say aye. Aye. Okay, we have approved minutes. Next item, Austin is going to provide a brief description outline of the report, and it's basically just a skeleton at this point, so we can see kind of what the format would be. But Austin, take it away.
Thank you, Chair and members. And just for those in the room, we have Jacqueline, Jessica, and Tim right now on Zoom, joining us remotely. We thought it prudent that I go over what the work of this task force will culminate into. I'll quickly go over the section of the enabling legislation that discusses the report. So this task force must submit a report to the Commissioners of Commerce, Housing Finance Agency, Employment and Economic Development, as well as the chairs and ranking minority members of the legislative committees having jurisdiction over those agencies. The report must include a summary of the activities of the task force, provide findings and recommendations adopted by the task force, make recommendations related to tort reform that could reduce insurance costs, include any draft legislation to implement the recommendations, and finally, include other information the task force believes necessary. In your packets is a table of contents of what would be common for an LCC report. It includes an executive summary, as well as a list of the membership, the enabling legislation, the overview of the meetings, which are listed there to date, and then the bulk of the report would be the recommendations and any draft legislation that comes of it. And finally, there's several appendices. One would be the full statutory authority, and then a few appendices containing the committee materials. We have two locations where information is located on our website. One is the meeting, I think it's just listed as meeting materials, and then there's one that's the background information. So those will be two separate appendices likely. And then as well as possibly a full list of the recommendations that were received but not adopted. That's been something that other task forces have done in the past. Thank you.
Yeah, members, comments or questions?
Thank you, Chair and members. I'll have a draft submitted to you all via email before the first January meeting. Likely containing everything except for the recommendations and the draft legislation. Thank you.
Okay, so we don't have any hearing items today, so we've reserved this one to dive right into the discussion. We had, I think, a very productive meeting last time and really got into some of the meat of what I hope we'll talk about today. And the first three things that there seems from the the comments, recommendations that have been submitted by members, a lot of interest in the fair possible expansion of the FAIR plan, some form of the fortified standards, strengthening Minnesota homes, and alternative dispute resolution. And if we have time, I think we will want to get into the tort reform discussion. If we don't today, then we'll make that the focus of the discussion at the first January meeting. Okay, all right. I'll kick off. So start with the FAIR plan. Kick off the discussion there. So the perception that where I'm at right now is that. As we discussed at the last meeting, we're seeing a lot of especially older homeowners associations and older affordable housing buildings are really having a hard time getting coverage. They're to the extent that they're getting coverage, it's coming in the surplus lines, and I think it's really good that that's happening because it gives us, a window kind of into a shadow market, what the market will do on its own. But by keeping all of that coverage strictly in the surplus lines, the associations, the properties that are covered there don't really have any of the same consumer protections they would have if it were in the admitted lines category. And one way that it looks like it's feasible to address this is by expanding the application of the Fair Plan framework into those markets. And I think between meetings, there's been a little bit of discussion. I asked Josh to reach out to Gary about the apartments part of it, or I'm sorry, the Homeowners Association part of it. Carrie has had some discussions with them about the affordable housing part of it. And they're at the point of just kind of assembling the kind of data that Gary and company and us we would need in order to evaluate an outline of such an approach. But I think that line of work, and then Commerce will have a lot of work to do, staff will have a lot of work to do on that as well. But I think we're at a point where some constructive work along those lines can proceed at this point. So others. Aaron's looking thoughtful.
Well, Mr. Chair, I mean, I'm struck by this notion that we're of the belief that the FAIR Plan is going to be kind of the be-all and end-all for all that ails the state. I think that the FAIR Plan exists for a very valid reason, and I don't think that purpose is to be in competition with the E&S market. I think that this is out there, and I think that, trying to push, I think people are going to be disappointed to think that the FAIR Plan is going to accomplish what I think the hopes of this are going to be. I mean, the FAIR Plan exists for a very good, very valid reason, but I don't think the FAIR Plan was ever intended to be a long-term solution for anybody to go into. And I think setting people up for that are going to be, I think there's going to be some disappointment.
Be careful about overselling it. See a lot of head nodding, so. Other comments? Jean, you're pensive over there.
Well, like Aaron, I have concerns with the FAIR Plan approach. I think we believe that's a panacea to the affordability issue, and it was never intended for that purpose. And how we're going to make that plan affordable as opposed to the excess and surplus lines market or the traditional market is a challenge. The rates are where they are because that's where the losses are, and we will see that same scenario in the FAIR Plan. And if the FAIR Plan loses money as a result of pricing at a depressed level and assesses insurance companies, the insurance companies will leave the state. And then we will have an even more difficult marketplace because we're going to see everything going in the FAIR Plan will be Florida all over again. That's my concern.
Okay. Josh?
The lonely side of the room.
The lonely side of the
All the
table,
cool
yeah.
kids are over there.
And we've got a bunch of people online who are, welcome to chip in as well.
Yeah, I mean, I have no illusions that the FAIR Plan could be the silver bullet. There is no silver bullet to the issue. I mean, if the restrictions are truly, I think 1.9 million was the max that they're able to write on a policy. I mean, that eliminates, I don't know, 80% of associations, coming from my world. So, it doesn't mean it's not something to look into as a third market alternative, maybe, without understanding the repercussions of the whole industry. But if that is the current criteria, it's certainly the impact it could have would be minimal.
Yeah,
but
so
certainly something to
that-
talk through,
So
though.
limitations like that have to be on the table. Yeah.
Mr. Chair, I would also say, I mean, and I know this is probably a crazy thought in this, in this task force, but the market is responding to, you know, a softening of what we've seen in losses the last couple of years. The market significantly hardened, following, well, I mean, 2022 explicitly. I mean, when, you know, especially Minnesota insurers saw a combined ratio of 192% in that year. The market naturally hardened because insurers were trying to figure out where the last couple of years have been a little bit better. We haven't seen quite the same level of storm losses, and as a result, we're seeing some softening of the market. I talked to a carrier CEO yesterday that said, you know, reinsurance terms are starting to ease a little bit. Prices are starting to come down. I mean, there is a market forces at work here that is natural, and some of this stuff is hopefully gonna come back and somewhat fix itself.
Yeah, I would agree with that. I mean, I'm not contrary. I mean, it does, I do think even the FAIR Plan itself is something, it's a buffer in hard times. And I think we've seen in other states as well, as markets are normalizing, reliance on it fades as well. So it might be something that is, is a temporary salve, but, you know, getting, the one advantage that it has over the surplus lines is that you do get the consumers do have the same kind of consumer protections that they would have under the, in the admitted market. Peter, am I wrong about that? No. So I see that as a big advantage. Gary? Oh, Carrie Johnson?
Yeah, hi, Mr. Chair. Thank you so much. I, appreciate the direction of the task force and, just want to chime in and say, I understand the affordability conversation, but I do think part of the conversation is also availability. And as you've heard from MCCD members and owners of affordable housing or naturally occurring affordable housing, filing 50 applications to maybe receive one quote, even from a surplus line, doesn't seem like the best way to ensure that there's availability, as well as, this is an option, as Chair Elkins mentioned, and Peter alluded to, that does have, a little more of the consumer protection side of it. And so I do think this could be a good option. It doesn't really seem like the industry wants to insure affordable housing. So I kind of feel like we're being stuck in a rock and a hard place right now. And we need insurance to, they need insurance to continue to operate. And I think we'd love to be in the admitted market, but I don't also know what those solutions are. And so if the FAIR Plan, if the industry is not saying that the FAIR Plan is the best way to move forward, how can we move affordable housing providers, multifamily providers back into the admitted market, I think is maybe another question that we could explore. But I am really interested in seeing what the FAIR Plan could offer, specifically for the areas where the insurance industry doesn't seem to want to provide coverage.
Okay. Jean? Mm-hmm.
Mr. Chair, just a couple of comments. The E&S lack of guarantee fund protection has been brought up a couple of times, and I just bring up the other side of that the E&S market has more flexibility and fluidity and is able to respond very quickly to changes that occur in the marketplace and is not dictated by approval of rates, forms, et cetera. So there is a plus side to that piece. And as I think Mr. Lynch brought up, we have not seen a problem with failures in the E&S marketplace. So in some ways, we're creating a problem that doesn't exist here. To Ms. Johnson's comments, I can only speak to what I see, but I work with a lot of affordable housing, and we've actually seen renewals be much easier to place, and we've seen in a number of cases that rates have gone down instead of up this year. Also, we handle the majority of the application process as an agent or broker on behalf of our client and complete that based on the information that we have. Now, if somebody is approaching 10 different agents and got them all going different places, then they're probably going to hand out an application because they think there's not much likelihood that this person's going to work with them. They aren't building a relationship. They're just going out and getting bids. So I again can't speak to that situation, but I can say that that's not what we're seeing in the affordable space.
From your side, yeah. I think we're hearing enough testimony from the viewpoint of the condo owners and the affordable housing purveyors. They're both seeing it.
Yeah, I would echo that actually from the HOA side. I mean, even in the last 3, 4, or 5 months, there certainly has been a softening. I mean, I actually got to tell a board of directors at an association I take care of, like, sit down, please. I'm going to tell you that there's actually a decrease in your insurance premium. And it's the first time I've said that in 10 plus years. So there's certainly a softening. What led to, though, this is, the number of carriers, the availability of the policies, the escalating premiums. Obviously, that's what kind of brought us here. But yeah, there's certainly optimism and, but looking at how we can, if there's a way to help avoid, the storm that kind of became in 2025, 2024, the market.
Yeah, and I think I'd piggyback on that. I mean, I think the thing that we want to make sure we do, and I think the best thing that come out of this task force is furthering, an ability for the market to continue to soften where this becomes available, and that's dealing from our standpoint on the claims costs. I mean, and so addressing what are driving claims costs, and if we can continue to bring or work to bring those costs down, that this task force and the legislature have control over, that'll continue to help, with the softening of the market. I mean, I think the last thing we want to do is, as we've seen, kind of a positive trend in the market right now, to do anything, or for the legislature to do anything that's going to make it, more challenging, or kind of stop the progress that we've seen over the last few months.
Okay. Okay.
Mr. Chair, can I guess as we talk about the FAIR plan, what is the exact proposal that we're looking at? I mean, what's the recommendation? I mean, what are, from the
Yeah, so we're looking for data from Josh's group and Carrie's group to come up with what would be appropriate parameters. But I think what I'm seeing, perhaps recommending, is that we look at having something for them under the FAIR plan that would be competitive with the excess and surplus lines, but not, the FAIR plan is not supposed to be competitive with business in the admitted market, but something that might be competitive with what's available in the E&S lines, but offer the same kind of consumer protections that would be seen if the admitted market was serving these constituencies.
Well, then, Mr. Chair, what's the metric that we're going to use on affordability?
I would say competitive with the prices that are available in the excess and surplus lines market.
Well, this is where things, I think, become a little challenging, because we get to the point of the FAIR plan exists, and when the FAIR plan runs a deficit, it is assessed back against insurers in the fully insured market. And so we run a challenge of artificially deflating what the premium is relative to the risk that is presented. And so we're artificially buying down the price of someone relative to their risk. And instead, we're going to put it on everybody else in the fully insured market, all of us, who are now going to pay artificially more relative to our risk. And I think that's where we just have a fundamental problem or challenge with. The FAIR Plan exists, as I've said, I mean, and serves a crucial function, but the notion that the FAIR Plan should have any consideration of affordability, I think is a dangerous slope to walk down, because you're getting market signals, and one of the functions of what insurance exists for, to show you what your risk is. And so people then make changes and make decisions to relative to what that price signal from insurers are relative to the risk, and we take that out in the FAIR Plan. I think that's really problematic.
That is what the FAIR Plan does. It does it on a very small scale right now,
But not in the metric of affordability.
yeah. Peter?
Mr. Chair, I think we might be like getting a little ahead of ourselves.
Okay.
It's, in looking at the proposed recommendations from task force members, I think there's like 3 buckets of things. There is a universe of what does the FAIR Plan do today, which doesn't seem like we're really talking about around the table at the moment, so I'm going to set that one aside. And then there seem to be 2 ideas around asking the FAIR Plan to potentially do something in the future that it doesn't do today. 1, to offer a product to affordable housing providers, and 2, to offer a product to common interest communities. I wonder if we might be able to hear from Mr. Rupp a little bit about what it would take for the FAIR Plan to even get to a position to potentially do either one of those other 2 things. Because I think in terms of, to Aaron's point about what recommendation are we really talking about here, I could see the task force maybe giving some direction to the FAIR Plan to explore what it would take to do those 2 things. We're not, I don't think, talking about a legislative direction to the FAIR Plan that thou shalt sell a product. And I think Mr. Rupp can give us some valuable context about what kind of timeline are we really talking about?
Yep.
What would it really entail? Because the FAIR Plan isn't going to be able to do either one of those 2 things in 2026, certainly, and it may take even longer than that. So I think before we get into is this a good idea? I think the FAIR Plan is probably best positioned to tell us a little bit about what it would take to even get us to a position to evaluate whether or not it is or is not a good idea.
Yeah, so Mr. Rupp, can you come to the testifiers table?
All right. Well, I appreciate you allowing me to speak again.
Yeah.
Because like I said, the FAIR Plan, we're pretty unique, and not everybody understands what we do, and it takes a while to kind of pick up on everything. And I think I would echo Aaron's initial thought, where there's no way that the FAIR Plan can solve all these problems. I mean, just from a capacity standpoint, if you're looking at the homeowners associations, I think there are 5,000 of them across the state is what they testified to last week. And then we're also looking, at the affordable housing part of it. And I have exchanged some emails, I guess with Josh today and then Carrie last week. And one of the questions I asked Carrie was, okay, what are your pain points? I mean, so there's this whole, and I'm not even sure what they cover and when you say affordable housing, I wasn't personally even sure. Are we talking about single family residence? Are we talking about multi-unit apartment complexes? And she gave me, and I don't remember the exact numbers, but she gave me like apartment buildings between certain parameters. And I think that's kind of a good starting point for that discussion, because we can't, and we're not going to be talking about apartment buildings across the state of Minnesota. We're going to be talking about a subset of a subset where maybe we can have an impact where, on these certain areas of affordable housing apartments, maybe there's something we could put together, to address this small subset. And I would say the same thing with the discussions I can have with Josh to kind of identify, okay, there's just so many different types of associations, so many different sizes, so many different formats that we can't even begin to address all of them. But maybe as we go through the discussions, maybe we can come to a certain subset of, okay, here's a small subset of apartment, of HOAs that, hey, here's something, maybe we can offer a affordable product. Or maybe not affordable, but, and offer a product they can work with. And to get to that point, it would take us a lot of research. I mean, I was, thinking that, at the Fair Plan right now, we run really lean on our staff. I mean, we have just 5 people on the staff, and we actually outsource some different things. So I think if we did, I think once we get beyond the initial discussions, obviously I'd have to go to my board to get the approval to allocate resources. But I think we're looking at, we'd be looking at hiring at least one person, kind of off the bat to even start the research. And then in addition to that, we're going to have to bring in a host of different experts, because we're not, I'm going to say we're experts in homeowners, personal lines insurance. We know very little. I mean, I know, and I've been in the industry for 30 years, so, and I've dealt with homeowners associations and stuff, so I know a little bit, but I think at this point, I probably don't know what I don't know, right? So I'll have a lot to learn. And so we're going to have to bring in some experts, probably, in the terms of actuaries as far as rates, maybe some, underwriting people as far as, hiring consultants for, how to set up the underwriting, probably also working with the reinsurance to set it up, what kind of risks would be able to get, I think if you go back to the reinsurance discussion from last meeting, I mean, there's a lot of talk about the different concentration and the different ways that some companies, buy a little reinsurance because they have the national exposure, and some companies buy a little reinsurance because, or, there's various types of reinsurance or sizes, and I'm assuming we'd buy a lot of reinsurance, so we'd have to bring in those people as well. We'd have to bring in our IT people to see what kind of system changes we'd have to make. So, I mean, there's just a whole host of kind of things that we'd have to look at from an administrative or just a operational standpoint that we'd have to look at, in addition to looking at, okay, what's this going to look like as far as rates? What's this going to look at in other aspects? So I don't know if that kind of covers what Peter was thinking about, or if there's more that you want me to add to that.
Yeah, Peter?
Mr. Chairman and Mr. Rupp, that's great. Thank you. I think that context is super important for us as we think about framing up like what a recommendation in this space really could be. I think the legislature doesn't necessarily need to pass a bill to ask the Fair Plan to work on that. But I think, Mr. Rupp, hearing you talk it through and talking about maybe hiring a person to help conduct some of the research might allow you then to be able to report back to the legislature
Right.
on the feasibility, and then public policymakers can weigh pros and cons in a future session about whether or not that's something that is in the public interest. I agree with Mr. Cocking's point about the A in Fair Plan being about access, and I think what we've heard from the providers of affordable housing and from common interest community members is that there does seem to be an access problem. And so having the Fair Plan examine whether or not having a product is viable to help alleviate the access issue or the availability issue might be useful. It might turn out to be a terrible idea. I think that's the question that we should maybe think about is scoping a recommendation in this space to maybe thinking about what the Fair Plan could provide back to the legislature at some future point, and whether or not there are, do we need to pass a bill to do that, or is that something that the Fair Plan can do on its own?
We probably would need an appropriation, at least a small one.
Well, and I guess, I actually don't know if that's true. I mean, Mr. Rupp, this is maybe something for you to think about, and obviously the board would need to think about it as well too, but if you're hiring a person, I don't know if that would, that wouldn't deplete your cash reserves and necessitate an assessment that would be passed on to policyholders. So I think there may be some ability for the Fair Plan to do a lot of this work without any assistance from the state.
Okay.
And I think as far as triggering an assessment, right now, I think kind of was discussed earlier with the last 2 years being good years. They've been good years for us too. I mean, we were on the verge of an assessment, at the end of 2023. And we kind of pulled back from that. We probably should have assessed actually, but we knew we had a rate increase coming, and the storms seemed to be turning in our favor. So we kind of put it off for a couple of months, and things turned around, so we didn't have to assess. So we're in a pretty good position right now, cash wise, but that can change. As small as we are, either the lack of an event or one event just impacts us greatly. Like if we have, we have several, we probably have, between 8 and 10 properties insured for over, $1 million or $1.5 million. If one of those were to burn down, we might have to look at an assessment almost immediately if that doesn't happen. But right now, I mean, as far as cash position, we're in the best spot we've been in probably in the last 5 to 6 years. So we are sitting pretty good on that end of it. The other thing I guess maybe I didn't mention before, and this kind of gets, I think Aaron brought it up earlier, is just, if we did expand into these markets, how do we capitalize that? We would have to do an assessment. So I think there would have to be some thought to it as well as if we did move into either of those markets, what would be the maximum exposure we would take on any one property, and what would be the maximum exposure we would take on this, on the book as a whole. I think even if you look at all I think they say there's hundreds of surplus lines carriers, but I don't think even those that write associations, I don't think any of them want to come into Minnesota and take every association because, if a storm came through, they're going to get annihilated in that sense. So there's just some issue of spreading the risk around. So even if we did say we moved into that market to some extent, I think there would have to be some thought given to how much exposure we'd want to move on, because we would have to, have a rather large assessment initially. And then hopefully once we make that large assessment, I guess our hope is we break even going forward and not have to assess again, but, we don't know how that's going to work out. So there would be that aspect of it as well.
Makes sense to me.
I mean, I think Mr. Rupp hit on just a fundamental problem of the state-specific FAIR plans and the limitations, and that's the issue of concentration. I mean, just without being able to diversify out into multiple areas, I mean, that's the benefit that the E&S market has, is they're able to take it not only nationwide, but in some instances globally. I think piggybacking on Peter's idea, though, I mean, I think if we're talking about the notion of expanding the FAIR plan to be able to potentially offer to HOAs or to multifamily housing, without the directive of some form of affordability, I think that makes sense. I mean, if we're gonna open it up potentially, and say we're gonna run it the same way as we do for everything else in the fair, I mean, I think we're talking about access. I mean, I think there could be an argument that makes sense there, as long as we're not putting it on and say, okay, but now you've got to hit these affordability metrics. I think that's the fear that we have. But I think Mr. Rupp, I think hit was dead on, and I think the capitalization becomes a big problem, because if multifamily or HOAs, I mean, you're not talking about insignificant property values, and you can get, to one loss very quickly, that then we're coming back as an assessment on the rest of the insured market. And I think that's the challenge, is how do we get to the point of adequate capitalization to be able to allow you then to start writing from the get-go before you kind of build up on having a couple years of premiums, hopefully without any losses.
Well, and I think too, and the other piece of that would be just from an administrative standpoint, if we take on too much risk, and we have a significant storm event come through, obviously it's going to hit us financially, but it's also going to hurt us operationally, because, we don't have an army of claims people sitting by to handle the claims. So if we take on too much risk, we'd have a hard time addressing those claims. Obviously, we'd probably outsource that. But in times of storms and things, we've seen, the availability of those resources is limited, and the cost to hire them, and sometimes the quality of their work is, in question as well, too. So I think we wouldn't want to, if we move into these things, we don't want to take on too much that's going to make it, impossible for, we wouldn't want to have to write the business and then have claims come through, and then all of a sudden we're here discussing how horrible the FAIR plan is at handling claims because we don't have the resources as well. So, I mean, we take a lot of pride in how we handle our claims. But by the way, I should mention that all of our Beltrami County claims have been settled. So,
They have.
yeah, so we settled all those. So, except for, we only had like a dozen, so we didn't have a lot. I think we had one that was reported in November that might still be open, but, so we kind of dodged the bullet, although we may be growing in that area in the next few years, so.
I think Carrie Johnson online has a question or a comment.
Yeah, thank you, Mr. Chair. And just want to chime in a couple of thoughts. And Aaron, to your point, I've been mostly focused on availability of coverage for the multifamily providers. I know that the affordability conversation, of course, I would love that, but I know that that is maybe a field dream. And that being said, like, I do think it's great to see and the market softening a little bit. And I have heard from a few members, but there are still some members who have had some challenges this past year renewing their plans. And I do think having the availability of this, of a safety net really for these properties that are really struggling to get coverage. To your question about kind of diversifying coverage, is there like a kind of National Association of Fair Plans? I guess I'm kind of almost curious if there could be, and this probably wouldn't be initially, but like a multi-state fair plan for this specific type of product or the products, you know, like for the common interest communities or affordable housing, where there were kind of multiple states, you know, that funded it together. And then I guess, yeah, if in terms of, you know, starting up the new products, what would you need financially to make that happen? And I guess that'd be a good question or something good to know heading into recommendations as well. Adequately capitalize the.
Yeah.
The market.
If you want me to address that, or if Aaron, you want to jump? I would say, what I would say for the capitalization, we wouldn't know until we knew what kind of risks we were taking and the amount of the risks. I mean, we'd have to, I assume, get an actuarial review of, okay, this is how much, you know, policy limits we're taking on, how much money do we need in surplus or reserves or whatever, however you want to address it, to handle the claims if something comes up. So we really wouldn't know that until we really dug into the numbers and said, here's, you know, kind of the types of properties we were looking to insure, here's how much they're going to be insured for, and here's what our rates are going to be, and then we'd kind of look at the capitalization at that point. So that's kind of maybe the end of the road as far as how much money you need when you kind of decide what kind of business you're going to take on. I don't know if the industry people have anything to add to that or clarify that as well.
Yeah, Peter?
Well, and I think, thank you, Mr. Rupp, or Mr. Chair, and Mr. Rupp, I think like this is exactly why I think we need to have some study, some real evaluation of what it would take in order for the FAIR Plan to do these two things that it doesn't do today. And I think, you know, from a regulatory standpoint, Mr. Rupp, I think your point earlier about having the expertise in homeowners that the FAIR Plan has now. If you think about an insurance company, a big insurance company that sells homeowners and commercial products, you're going to probably have those in two separate divisions. So you're going to need a variety of different organizational structures in addition to the actual product offering itself. But I think I'm hearing sort of around the table that there may be some consensus about, you know, recommendation that is from the task force to the FAIR Plan to sort of try to explore these things and then bring something back to the legislature, because only once that actuarial study, that organizational study, that comparison to other FAIR Plans around the country, I mean, there certainly are other FAIR Plans that insure condo buildings. There are a number of other FAIR Plans around the state or around the country that have raised their limits, but you need a plan to do that responsibly. And that's not something that the task force is set up to be able to articulate and dictate to the FAIR Plan at the moment.
I think we're getting a consensus around that as well.
And I think, I mean, if we're going to, I mean, now is kind of the time to be working on this as the market's softening. I feel like you couldn't do this with a hardening market because you'd have too much demand and not enough. I mean, but now that we're seeing a softening of the market, hopefully the demand is subsiding a little bit as we're able to find, you know, renewals, you know, outside of this. And that might help the FAIR Plan to be able to capitalize somewhat before you have another hardening of the market.
Yep.
This is all cyclical. We'll see this again at some point. And
Yeah.
I guess the other question, whether there's like a multi-state FAIR Plan or anything like that, there currently is not. I mean, there's a, you know, PIPSO, which is like a trade organization that we share information with, and we share kind of like best practices and things like that. But every state is so different as far as how the legislation's set up, how the risks are involved. I mean, you know, if you go to Massachusetts or Florida or California, I mean, their FAIR Plans are the largest, or nearly the largest insurers in the state, you know, versus us in the Midwest where we don't have the coastal thing. So there's so many differences between the different states that I don't think you could set up a multi-state FAIR Plan. I mean, the best we can do, and I think, if we do move forward with some kind of research like this, we'll maybe lean a little bit on the larger states that are already doing some associations to find out, how they've done it. But we're very similar, but yet we're also very different. It's not a lot of similarities between a lot of different things, so.
Can I ask, forgive my ignorance on it, but does the FAIR Plan write HO6 policies? I mean, can homeowners come to you?
Yeah, we write HO4 renters, HO6 unit owners, and then the HO8 homeowners. But I would say, the renters policy, HO4, we got a handful of those. I think we have like 60, maybe at the most, of the HO6s. So we do write those, but we don't see very many people coming to us for those policies.
There's a reason why I'm going down this path. We don't need to go down completely today, but, I mean, is there a capacity at some point that if associations were to purchase HO6 policies on behalf of homeowners within associations, essentially to make sure everyone's insured, would there be an avenue that associations could come to you to say, I need 5 HO6 policies in this association? Is that a
Yeah,
potential?
I guess getting back to the availability, it'd have to be a situation where there aren't available anywhere else. Because again, and then the other piece of that would be, I don't know that anybody would want to insure all the I think you'd want to spread that around, if you did spread that around between a lot of different companies, because you wouldn't want, someone concentrated on all that risk in that one area. But we do, and I don't know if we haven't seen it from our viewpoint of people having trouble getting HO6 policy. Like I said, we have a handful of them, but we don't see them very often. But, maybe there's people out there who can't get it and who just bother to go, just go without. We don't know if that's a huge market out there that, that could come to us as well. And I'm trying to think of, the one thing, getting back to maybe Carrie's last question on the FAIR plans across the country, I think, there are some different things going on in different states, not to this extent, but, so we can leverage those, information. They might have some information to share with us as well that we can use to research this, so.
Okay, cool. So Austin, do you feel like you have enough information to summarize where we are? Okay. Jean, did you have?
I just wanted to briefly add that the other elephant we're not addressing here is the cap on how large of an association or affordable housing property we'd be looking at. The reinsurance market is able to respond to the E&S carriers because they have a large volume of business with a spread of risk. We start trying to place reinsurance on properties that are 25 million, 50 million of values, you're going to be so priced out of the marketplace from that perspective that it would not make any logical sense. So if we're going to address this, it's got to be for the smaller ones, in my opinion, although I defer to Mr. Cocking, who's.
Yeah, and I think Josh touched on that as well. So that parameter is an important part of the study. Okay.
Just one final question, Mr. Rupp. Colorado, obviously, as we know, is the last state that set up a new FAIR plan and just got up and running. What was the process and how they originally capitalized?
Well, I believe they did like a $50 million assessment.
Okay.
But I could be wrong on that, but I know it was a large assessment, and they're doing something different with associations and commercial policies. They're writing like the first 5 million in coverage is kind of the first layer of, and, I talked with the director of the Colorado plan about a month ago, and I think they had sold one policy on that, so they really haven't been a demand for it. Because it really, it adds a lot to the cost. I think the premium, if I remember right, there was like a $5 million coverage, and the premium was like $35,000. And that coverage was actually on a association that was under construction. And they may have written more since then. Like I said, they're very, very new.
Yep.
So there may be, they may have brought in some more business, but they haven't really seen an uptick in their business as well, so.
Okay. Have we chewed this one up enough? think so. I think we're good. So Austin's going to summarize and to make sure that the consensus we think we have, we really have. So we'll circulate that and for comment and before the next meeting. Okay, next thing on the list is the Strengthen Minnesota Homes topic. A lot of comment there. I would say that from my own perspective, I think that I think that I would want to, give some direction to the Department of Labor and Industry to look at strengthening of the building codes, maybe not all the way to where Alabama is. We're not that there, but come up with something that's appropriate for Minnesota and have it go through their normal construction code council process rather than directing them to do anything specific. And then the second big thing is that we want to, provide whatever resources are necessary to fund and stand up the program that the legislature started getting in motion a couple of years ago. And I think we're probably close to a consensus on that one as well. Peter, do you have any comments? Because you guys will have to staff up a little bit, I think, for this one, won't you?
Yes, Mr. Chair, going back to the governor's budget recommendation from 2023, when the department first proposed the program, I think, we articulated what we would need from a staffing and operational standpoint. I think, it's some combination of people who are working with consumers, some combination of people working with contractors and evaluators. We need some of the back office people who would be handling the dollars and the accounting functions. I think we would want to make sure that we're appropriately examining the program for internal controls and making sure we're setting that up correctly from the get-go. So I think there's some staffing resources that we would need, and then there's whatever amount of resources would be provided and made available to Minnesotans from a grant
Are
perspective.
you close to being able to, or is the department close to being able to give us recommendations on that?
On which portion, Mr. Chair?
On how much it will cost you to do your part of the implementation?
I think we could go back to the governor's budget recommendations from 2023. And I think, in some part, it will depend a little bit on how big, is the legislative intent to sort of run a full-blown program? Is the legislative intent to start with a pilot and then maybe come back and get bigger? I think we can scale from a staffing perspective based on, the resources that are available. So I think, we can work with Austin and think about how to come up with a recommendation there. I think the broad strokes of, fully fund, the task force can recommend that. It's going to be up to legislators during the session to see if that can become a
It's gonna be a tough
reality.
supplemental budget year, so the incremental approach might be more successful from that perspective. Mr. Cocking?
What did we, Peter, Mr. Brickway, what did we fund originally as part of, I feel like we gave, is it $1.5 million?
Mr. Chair, we received $1 million in planning funds from the legislature in 2023 to sort of stand up in the program and begin to do some of the operational work. But that, isn't enough long-term to, that was a one-time appropriation, so that doesn't, provide for
Have you
staffing
spent it all?
resources. I don't believe we've spent it all, Mr. Chairman, no, but I don't think it would be enough to, start actually making grants out in a significant way.
I know there was a lot of data 2 or 3 sessions ago and testimony about strengthening homes, storm-resistant materials. In that data, was there any, maybe we're not there yet, was there any correlation to premiums, an effect on premiums with better materials? Was there any data that suggested that there was
Well, I
an
think we got
effect?
the good data on that from the Alabama stuff.
Yeah, Mr. Chair, I think the Hurricane Sally study that
Yeah.
Professor Powell presented on is probably the best analysis there. And I'd sort of defer to the industry folks on the rate making side of what that looks like going proactively. I think we have a really good understanding of what the avoided costs for consumers could be, and the avoided costs for companies from a claims perspective if you were at that fortified standard and you had an extreme weather event go through the community.
part of the challenge that when we had done the fortified program in Minnesota that the department had brought forward in 2023 was that Minnesota was going to be the first kind of Midwestern state that implemented this, and to get a sense of what that looked like. We knew what it did on the hurricane stuff from the fortified program in Alabama, in North Carolina, and in Oklahoma, but we didn't have kind of a proof in the pudding of what that meant for any of the Midwestern states. And I think that was one of the frustrations about not being able to get the grant, is we still don't kind of have that information about what that looks like. What are we seeing on saved loss costs? But you put on, class 4 impact resistant shingles, you're going to see a reduction in losses, which correlates to, I mean, anything that we can do to decrease losses brings down premiums. And so that's the, getting at those, and how do we put on better roofing materials that are better able to withstand these storms? And I think that's, from our standpoint, the benefit of funding these grants is to get a handful of these roofs on and fortified, and then have a couple years of storms come through and see what does that look like and what does that mean. Mr. Chair, I would also, I'm curious if maybe you can expand from your perspective on the Department of Labor and Industry and what you want to see from the building code changes. And, one of the insurance industry has always been supportive of building codes and enforcement of building codes. Minnesota has always been very reluctant to do statewide enforcement of building codes for several reasons. I'm curious from your standpoint how that works, and what do we do to get to that point?
Well, we can look at what Alabama did, but we don't have hurricanes. We have lots of hailstorms, which would mean that I would think would mean that the shingles themselves are probably relatively more important for us than it might be from them, whereas for them, a lot of it was, we have wind as well. We don't have 200-mile-an-hour winds, but how you attach the shingles is probably more important for them and might be less important for us. So we would need, probably to work with IHB, have them be involved in the DLI process to say, okay, what compared to Alabama, and what understanding what the differences are, what would make sense for for a Minnesota home. And I understand that the home builders will push back. I've already, I know them well, and I was their legislator of the year a couple of years ago, so I have a good working relationship with them, but I know that part of it will not be easy. So, but I'm willing to wage that battle. But yeah, I would like to see their process result in a fortified standard that is appropriate to the conditions that we face here, and I would expect that IBHS would be involved in that process.
Mr. Chair,
Adam.
just one question. Mr. Brickway, was the initial grant ask, was that $30 million?
Yes.
Do you have an idea of how many roofs we could fund with that kind of grant? And does that give us actionable data that we can then draw conclusions from as far as how well these roofs are going to perform in Minnesota weather as opposed to Alabama?
Yeah, I think a really good question. I think there is a sort of a simple math problem, right? If you sort of assume that grants could be up to $10,000, which is how most of the other state programs that do grant funding have operated, $10,000 per grant times X number of homes that's your appropriation. So I think, what I think success really looks like for a state program is in part about how many grants are you providing, but what Alabama, I think, has really shown other states how to do is that success is really about setting the economic environment in which people who don't need a grant in order to put a fortified roof on their home are able to do so because the workforce is trained and available and able to do that work. And that's why something only about 17% of all of the fortified roofs in the state of Alabama come from a grant. So I think we are really starting from zero, as you know, Adam, about how many fortified roofs we have right now. So I don't think I could say definitively we need to get to this number of grants in order to have enough experience. in the state to really be able to help from a pricing perspective. I think that's a question that I don't have the actuarial training to be able to definitively answer. But I think what we're aiming for is enough grants that we're able to create the economic environment where roofing contractors are just doing that
Motivated
and
to.
selling that product to any customer. And I think, Mr. Chair, that I hear sort of an echo of that in your interest in trying to have DLI incorporate this into the code review process, because that would also help create the economic environment where people are just able to get the stronger roofs as part of the normal course of replacing a roof.
It requires the home building industry to develop expertise.
Yeah.
Yeah.
I think, Mr. Chair, and Adam, I guess maybe one other final point. I think we would look to the state of Oklahoma, which this year started its pilot project and is up to, I think, just has done its 100th roof this year. But I think the Oklahoma department has been a real leader in using data that's collected from the insurance industry as part of a national effort to try to better understand where our risk exposures really are from a variety of perils. And the Oklahoma experience is, I think, much more similar to Minnesota's than certainly Alabama's is. And they have targeted their piloting of the project in specific zip codes in the Tulsa and Oklahoma City areas where they see the most risk exposure from severe convective storms and hail. And so I think starting it that way, making sure that you've got a program that works, that the grants are flowing properly, that you have adequate internal controls in the operation of the program initially, and then scaling up from there is a really smart way, and one that I think we would like to emulate about trying to start that program, because you're starting in the places where, in theory, you're going to get the best bang for your buck from a risk reduction standpoint, which helps with affordability from the pricing of the risk going down. So I think, if we can kind of get going, we should be able to hopefully get to a better answer to your question, Adam, as we both start to make grants, but then also create the economic environment where we have enough workforce to do fortified roofs without grants as well.
And then, Mr. Pung, is the industry through IBHS, starting to feel like there's enough data out there to be able to indicate what the appropriate discounts would be?
That may be a question for Mr. Brickwitty, as we did it about this time last year, initiated a data call trying to figure out through information that insurers had what the appropriate discount is. I think we're still in the midst, or the department's still in the midst of working with the NAIC Center for Excellence on determining what that number is. I know in the fortified statute that we passed in 2023, the language was requiring an actuarially justified discount, if I recall the language properly. And I think the department's working on trying to figure out what that range looks like.
Yeah, Mr. Chairman, Mr. Coggins, correct. We've been working with the industry on a voluntary data call using the law that the legislature passed for us this past session. And it's been a really interesting project. I think we're very close to being done. I just got the final technical document what day is it? It's Tuesday? I got it last Friday. So what I think, what we've seen in the course of that project broadly is that there's a wide range of understanding. I think the decision that we and the legislature made in 2023 to require the hail-resistant shingles was a smart idea, because the best actuarial bang for your buck in terms of a value from a cost standpoint is with that hail resistance. We certainly have some wind exposure, certainly, but the hail is the most costly peril. I think what's been interesting also about that project is that there is a variety of information that's available to insurers when they're setting rates, and a lot of it is dependent on kind of the assumptions and the quality of the data that go into the catastrophe models that they use as inputs. So it's been a really rewarding project. Really thank the industry for participating on a voluntary basis to help us sort of think about that. And that should help us have a more finely tuned regulatory process, so that when carriers do come in with filings with that discount, we understand why they're coming in with what they are coming in with, and we can move those through the process, the regulatory process quickly, efficiently, and make sure that those discounts are available to consumers as quickly as possible.
Anna?
I feel like
Sure.
those, oh, sorry. You want to go, Carrie?
Oh, you can go.
Okay. I feel like those discounts, though, would diminish over time, just because even an impact-resistant hail or a hail-resistant shingle, as they age, once they hit 10 years, we're kind of back in the same boat we are in right now. So I do think that's an important point, that it's not a long-term solution, because these fortified roofs still only last as long as they do.
Mr. Chair, yeah, I think we see the value analysis from the Alabama study really, I think, puts numbers on what that looks like. I mean, certainly any roof can fail under the right circumstances, but I think there is a material cost reduction from a claim standpoint for the companies that can be articulated and calculated, and you are seeing that passed on to consumers in the way that we created that law in 2023. So yeah, I think you're right in the long term, but like we're talking seriously long term. And in the meantime, if we can do more work to make our roofs more resilient and resistant to extreme weather pressures, that's going to provide short-term cost relief for consumers.
Gary?
Thank you, Mr. Chair. And yeah, I mean, I think I would like to see this program receive some funding and would support a recommendation, of funding for the task force to consider. And one thing I wanted to kind of bring up is, we've been talking about so for example, there are 5 Habitat homes that have used more climate resilient materials, fortified roofs. How can we, is there a standard or something that we can, once we hit that threshold, we can ensure that even if people didn't take part of the Strengthen Minnesota Homes grant program, can, receive a recognized discount on their insurance as well. And something I'm hoping, that we can work with Minnesota Housing on is starting to incorporate, especially like rehab and preservation properties for like funding. How can we start to incorporate this as well? And maybe that can start to make these, some of the multifamily affordable housing properties seem less riskier for insurers. And so I'm not saying that this would be the exact solution, but perhaps there is a pilot that we could do on the multifamily side to demonstrate whether or not, using more fortified or climate resilient materials could help reduce the risk on those properties as well. So just wanted to state that.
Mr. Coffey?
Carrie, a couple of great points. The first I would mention on the, if they had built, even if they had done it outside of kind of the traditional fortified way, the fortified standard that we set up and that IBHS runs, if you get an evaluator to, and Peter can correct me if I'm wrong, I think it's the evaluator to certify that your house is, meets those standards, you become eligible for that program for the discounts. The second point of that is that and I know that there's probably some disagreement from Mr. Brickwitty on this as we went back and forth on this in 2023. But if you're building to with more resistant materials to with products that are going to more easily withstand the climate pressures we see in this state, insurers are naturally going to look at that, and your premiums are going to reflect that because of the diminished risk that you present. And I think that comes back to kind of the fundamental case that I keep making repeatedly is that if you diminish your risk or you bring the potential loss exposure down for insurers, the price is going to go down. So.
Yeah, as long as it's visible to the
They've got to
insurer.
know, yeah.
Yeah.
And Aaron, thank you for that information. Could you, you mentioned assessors or underwriters, so.
Evaluators.
Or evaluators,
Yeah.
sorry, thank you. do we have, does the industry have enough evaluators that would be able, skilled in evaluating for these types of, materials? And is that something as well that, like a workforce need, I guess, because, we've already been talking about the need for more skilled laborers. Just wanting to kind of put together a list of, the workforce needs that we would need to carry out this program.
Yeah, so this is part of the challenge. So the evaluators are not actually insurance industry people. They're evaluators that have been certified by IBHS to be able to go and to determine those on an independent kind of third-party basis. And I think one of the challenges that we've seen, certainly coming out of the fortified law that was passed in 2023, without getting enough fortified homes started or in the pipeline, we haven't had a pressure to get the people certified as evaluators. And I don't know if Mr. Brickwitty's got more to add to that, but I know that's been one of the challenges we've seen is there's just not enough evaluators, period, because we don't have the fortified homes or the grants to kind of get this. It all becomes kind of like a chicken and an egg thing.
Yeah, Mr. Chairman, I think we're blending maybe 3 or 4 things together, so let me take them in turn. So we have, I think part of our focus this year has really been on trying to expand the workforce that's trained to be able to do fortified roofs. So big thank you to the Contractors Association of Minnesota, been a great partner in that. We are up to probably about 40 contractors around the state who have gone through the training and are available to do fortified roofs in Minnesota today. That's up from just a handful earlier this year, and most of those contractors were part of larger national organizations. We still don't have as many evaluators, so there's an opportunity there to continue to grow. And those are the third-party people who sort of validate that the work is done to the standard and can then allows IBHS to issue the designation. So that's one. I think 2, we have seen our colleagues at the Housing Finance Agency incorporate fortified standards into multifamily as an option for points on the consolidated RFP. So that's been really great. That's a way for affordable housing providers to sort of advance their applications as part of the consolidated RFP process by investing or trying to make these investments in resiliency. And I think all of that is to say that I think, an affordable housing provider, we talk about fortified as if it's one thing, but as we've heard from IBHS during their presentation, there are several versions of the standard. There's a retrofit standard, there's one that's sort of for new construction, primarily for single-family homes, and then there's also the multifamily standard separately. And so I think depending on the nature of the housing stock that a particular affordable housing provider has, an affordable housing provider that updates their roof to a fortified standard, multifamily or retrofit if it's a single-family home, they would be eligible for a premium discount or a rate reduction from their insurer right now under the law that we passed in 2023 and took effect in August of 2023. So there's we're talking about a lot of different things here, all really good things. I think that the unique, and Ms. Johnson can talk about this better than I can, I think some of the unique challenges that affordable housing providers have about raising capital to be able to make investments in their properties is something that we should maybe think through from a fortified standpoint as well in that context. But I think there are a lot of options available for them to be able to reduce the price of the risk.
And I think Tim Johnson is available online today. Tim, would you want to weigh on any of this, especially the availability of contracting talent to be able to start working on fortified roofs?
Yes, the manufacturers or suppliers are largely the drivers of this in that space. I know just sort of tangentially that they're pushing their contractors to get certified to be able to install their fortified products. I think if there's some incentive in the marketplace to start doing that or some awareness by consumers, it'll be pretty easy to mobilize contractors who are ready to do that. At least in the roofing space, the fortified procedure is not terribly complicated. It's not going to require a tremendous amount of training for the contractors to get up to speed on that. And if there's incentive or need in the marketplace for that work, there will be plenty of contractors to fill it.
Okay, that's good. Yeah.
Yeah, Mr. Chair, just one question that I had during Mr. Newman's testimony here, I think largely centered on the fortified roof program. But as Mr. Brickwitty mentioned, there are a couple different programs we're talking, and I believe it was Ms. Johnson that mentioned maybe a fortified standard for multifamily or commercial, which they have. We talked a little bit about the cost differential between a typical home as well as a fortified home. Are the range, or is the cost differential on a multi-housing facility similar to the residential single-family application of a fortified roof? Because I'm just thinking, if you got a 30 to 40-year-old building, what would the cost be to retrofit up to a fortified standard? It might be cost prohibitive. I don't know the answer to that, but I was just, as we're having this discussion, I just want to make sure that we're not talking about a standard that, some of these facilities just aren't, it's not going to be cost effective for them to bring their facility up to that standard.
Yeah, and I anticipate that would be part of the discussion in the Construction Code Council. So the single-family homes and apartments and commercial buildings are in two separate chapters of the building code. So they would need to chew up both of those.
Mr. Chair, and I think inherent in Mr. Axvick's question, which I think is a really good one, is also the sort of the public policy question of, as you're thinking about that simplified math problem of how many roofs are you trying to provide grants for. I think $10,000 as a maximum grant amount from other states is not designed to buy everyone who gets a grant a full roof. And that certainly would be the case in I think in Minnesota. Mr. Johnson can correct me if I'm wrong, but I think generally speaking, the all-in cost of replacing a single-family home roof and certainly a multifamily property would be more than $10,000. I think you're either trying to buy everyone like a whole roof, or you're trying to cover with the grant program the delta between the cost of doing a regular roof and a fortified roof, and that delta certainly would, I think, be $10,000 or less. So it's a really good question. I don't know the answer to, but I'm sure we could get some input from IBHS on it.
I was just going to say, I think I also share some of the concerns, Adam, that I'm not sure this is, if this is the best return on investment for multifamily properties, or if there are other things that we should focus on. And so that's why, I'm not jumping all in on the multifamily side, but I do want to maybe explore if there is a pilot program that we could potentially do with specific types of properties where there would be, where there could actually be a significant impact. And again, I think to Peter's point, if there are specific locations that it would be best suited to potentially focus on, that would be of interest as well. But, and maybe we can work to find some philanthropic funding or something to pair with it as a pilot program. I know that this kind of doesn't exist anywhere in the country, and so potentially could we use this as a test case? And I think there would be some interest just in some initial conversations that I've had around seeing if this could potentially be something emulated throughout, other areas as well, if we pursue some sort of pilot.
Yeah. Okay, have we chewed this one up enough? I think so. Austin, you good? Okay. Okay, so we're doing pretty good for time. So the one formally on the agenda today yet is alternative dispute resolution. So I think this one was kind of stimulated by the testimony from the county manager from Beltrami County and concerns about how long it was taking to get some of those claims settled, plus the point we've discussed a little bit earlier today about how do we get equivalent kinds of mediation mechanisms into the, like what's in surplus lines right now as we have in the admitted market. So look at the back to the chart. Is that 1.3? Hold on here. Here we go. Okay, so, yeah, so Austin is pointing me to the right place. Clarify the alternative dispute resolution statute so consumers and insurers understand that policyholders have 2 years from the date of loss to initiate the appraisal process for any type of claim. The recommendation would require legislative action. 8.3 says just improvements to the insurance claim mediation process. And then there's a related proposal to ban the use of credit scores in premium calculations. That might take more discussion, but basically it comes down, how do we address the kinds of things that the Beltrami County Commissioner was complaining about? Yeah, Peter.
Mr. Chairman, I'd go, from the department's perspective, we think this is a pretty straightforward technical fix that would be helpful to all parties. How many meetings ago was that? 2 meetings, 3 meetings ago that we had Mr. Berry's testimony?
About 3 meetings ago, yeah.
There was that moment where you started to give me a homework assignment, and I got out of that homework assignment because other people around the table had talked. But I thought that was actually a really interesting exchange.
Yep.
Because I think Mr. Berry kind of gave his perspective on what the law says.
Uh-huh.
And then Anna, you said something about what you thought the law said. And then I think it was Tim said something a third, and I would have actually said it slightly differently a fourth way. And so I thought that was illustrative of, we've got 4 really smart people who all work in the space, who all think the law says something a little bit different. And to me, that seems like a good point of clarification.
Yeah.
And I think that could be pretty easily done by looking at the language in 65A. So I think Mr. Berry's testimony, the department felt was very compelling in that space. I think clarifying the law so that all parties, policyholders, and consumers understand what it says makes a lot of sense. And then hopefully that leads to swifter resolution on claims disputes.
No?
I mean, I think on so many of these things, everybody comes in and thinks, aha, I have this idea that's gonna solve all the problems. I feel like, and I had actually driven up, to Bemidji to meet with Mr. Berry, and the county board up there and the mayor of Bemidji and some city council members to address the challenge they were seeing. And I think that I think he was overly Pollyannish on the value that this would bring in. I think there's a lot of issues that exist in the appraisal process right now. I'd be more interested in squaring the troubles that exist in the appraisal process right now away before we worked on expanding them to other things. But I don't have I'm not sure I've got a believer that there's a lot of silver bullets that exist in a lot of things. I think there's a lot of things that build on top of each other that make it a challenge to.
Mr. Chair, 8.2 was one that the department submitted, and we're not looking at it as an expansion of the appraisal process to things that it doesn't already apply to. I think it's a clarification of the law so that there's uniform understanding amongst policyholders and the industry about what the law actually requires. I think if there are problems within the appraisal process and how that works, between the 2 parties picking an appraiser and then the 2 of them selecting a third and moving that forward as an alternative dispute resolution mechanism so that people don't end up having to go into court, I think we'd be open to talking about those. But just to clarify that from the department's perspective, we're not viewing this as an expansion to something that it doesn't already apply to. It's that the law is not clear, as evidenced by the fact that 4 of us sat around the table and all had a slightly different interpretation of what it says.
And I guess I would just add, when I was talking, I wasn't really looking at the statute, I was looking at the policy language itself. I mean, the policy language is what governs the contract between the insured and the insurance company with the law overriding it, right? So I guess I'm not seeing in practice insurance carriers denying a policyholder's claim or demand for appraisal on a wind claim because the statute doesn't say wind in it or all perils. Like, we're still contractually obligated to go through that process as an insurance carrier.
And Mr. Chairman, I think that herein lies the rub, and that from our perspective is not the case for all carriers.
Okay. That was
so
what I
the-
took
so
away.
the- Yeah, so the
Others doing?
policyholder experience is different depending
Okay.
on who your insurer is.
Gotcha.
I'm sorry, who is? Oh, Tim Johnson, did you have a comment?
I do, and I'm actually sort of like neck deep in this issue, so I have a lot of relevant data as it relates to this particular issue. To Aaron's point, I agree, there's no silver bullet for anything, but I think there is a silver bullet for one thing. Sometimes claims take a long time, and they take longer than a year, especially when there's been widespread damage, and especially if there's any sort of dispute that needs to be resolved. That appraisal process is great, but it can take a significant amount of time for it to be completed. So to the issue, 65A quite clearly only applies to the perils of fire and lightning, and that one gives you 2 years. Minnesota's got a hail statute that only applies to hail, and that gives you 1 year. Most carriers in the state now, State Farm being the leader in this, have separated out their policies so that if you have a fire or lightning, you still get your 2 years that everybody's familiar with. That had been sort of the way of insurance policies for the last 20 years in Minnesota, but that changed recently. So they're splitting up their policies so that anything that isn't fire is 1 year, and anything that isn't hail isn't subject to appraisal. He's right. I got a stack of cases on my desk where State Farm specifically, and I'm only calling them out because they're the most recent. Many carriers are doing this to their policy, are not allowing those to go to appraisal. They're not allowing people to recover if they haven't performed work in 1 year, even when they haven't acknowledged the amount of loss. So simply clarifying 65A01, the standard fire policy to apply to all perils, would alleviate that time concern. Additionally, that particular statute protects the carriers as much as it protects consumers. So it being applied to all policies, in my mind, wouldn't be too offensive, but it would fix the time problem. And the time problem is what's really hurting a lot of policyholders. I'm not joking. I probably have a stack of more than 20 files on my desk dealing with that very issue.
Sure, just on a follow-up on that time point, I think particularly if you, what the department felt was compelling about the Beltrami County example is particularly in a community like Beltrami County where you have a limited number of attorneys, a limited number of contractors, a limited number of just humans to help you move through the claims process, that elongation of the claims process in and of itself creates real significant cost pressures for the consumer. And so I think getting some clarification here so you have this alternative mechanism that isn't going into litigation would provide at least another pathway to solving that time problem for policyholders.
Mr. Cockey?
The only point I would make on what Mr. Brickwitty just said is that I think that the notion that there's a lack of contractors is normally in Bemidji might be true, but as we know, the storm scamming contractors, when the storms come through, will take up residence and will buy up all the hotel rooms, and will when there's insurance money to be paid, they're gonna set up shop, and they're gonna mine that gold vein until it's gone, and we know that's true, and we all pay as a result of it.
Mr. Chairman, having also driven up to Bemidji and taking a tour and seeing a huge number of homes with tarps on their roofs still this month, I can tell you that that's just simply not actually playing out in that community. And so your point is well taken in the immediate wake of the storm, but here we are 6 months later, and we met community members and heard from local elected officials about homes that are still in active recovery because they have not been able to resolve their claims disputes
so
and get to the point where they can actually start with a contractor.
It may not be the lack of storm chasers, it may be the lack of adjusters. Yeah.
I think there might be another issue at play there when those properties suffer structural damage. The number of contractors that are confident or capable of handling those sort of issues, understanding structural loads, the actual ins and outs of buffing up a property that might be from the early 1900s, that diminishes significantly. So if we had, Iowa had 2 derechos in 20 and 2024, if that happened across the state of Minnesota, even though we've got 10,000 contractors, probably only 500 of them could actually deal with those issues. So when you're dealing with that scale and that type of a loss, it's really important that those people have enough time. I don't think it's the adjusters. I don't think there's enough contractors interested in driving that far who have that experience and competence.
Mr. Cockey?
Yeah, I mean, I think the other challenge, I mean, there's a host of things that I feel like were problematic in Bemidji. I know in my conversation that there were, that the folks up north were upset that insurers had brought in forensic engineers to show that a lot of the damage that was that they were trying to claim was actually damage that was pre-existing to the storm. And their thought, and they had said, well, insurers should just still pay that. And it's like, that's not how this works. And so, I mean, while there's still tarps on buildings up there, it's not all as a result of insurers not paying these. There are a handful of things that we all know in every claims process that play into that. And whether it's on the policyholder standpoint, the contractors, the insurer, I mean, we have no clue. And to say that somehow this is all the result of insurers not paying or insurers not doing on the appraisal process. I mean, the appraisal process that we're talking about extending from 1 year to 2 years, the Beltrami storm was in June. We're not even a year into this. So to suggest that somehow extending this from a year to 2 year solves this problem, I don't think we know that until we get to June 27th of 2026 and see that these are still. I think there's a host of things that came into play there, and it's unfortunate. But there were a lot of other scammers up there too. You know, we passed this bill on price gouging tree trimmers a couple years ago too. And I know that there were plenty of tree trimmers up there that had gone around and had said, we'll cut this down, we'll bill you, you just turn this into your insurance company, they'll pay for it. And so there were people that were stuck with bills for $40, $50, $60, $70, $80,000 to get rid of their trees. And then when the insurance company comes in and says, no, you actually don't have coverage for this because your tree fell down in your yard and not on your house, and so your insurance policy doesn't cover, then it's the insurance company that's still the bad guy because they're not paying a loss that never was contemplated in the contract to be paid in the first place. So I know that there's a lot of frustration up there, and a lot of it's borne out on how, bad insurance companies are or whatever, but I just don't think that that's the truth of what's actually the circumstances on the ground.
At least you're not health insurers.
I would just add that a lot of times roofs are covered with tarps too because they can't afford their 1% deductible or they have ACV roof coverage and there's a large out-of-pocket cost. So just to say, like, because that work's not done is because the insurance company is disputing it. There's a lot more to it. And I deal with these
Yeah,
tree
I don't think
contractors
anybody-
all the time.
Mr. Johnson?
Yeah, I don't think anybody would suggest that that's just the carriers being the problem. The carriers might need that amount of time as well at times. So I don't think it's that, and I hope nobody heard it that way. But if 65A applied to all losses, then those people would have 2 years and they'd have the right to appraisal if they didn't come to an agreement. We already do that for fires. I don't know why we would naturally treat any other loss a different way. So.
Mr. Rickwitty? No?
No, Mr. Chairman, I agree with what Mr. Johnson said, and although I would note, I think, like, again, we're having the same conversation we had a couple of times ago, where I think the law is not as clear cut as maybe it was just described there. So I think that, which raises the point of clarifying what the intent of 65A really is to apply to, would just help provide clear information to policyholders and insurers, so that to the extent there is a dispute that needs to be resolved, there's an option that is not just going into litigation.
Yeah, so I think you do now have a homework assignment for the agency to come back with a recommendation on that.
Well, I think that recommendation is, it's clarifying that 65A
Yeah.
applies for all types of claims, and it does so for 2 years.
You guys okay with that? All right, well, we'll take that as, so Peter's got a homework assignment, and you guys got to think about it until we meet again. Okay. Anyone else want to weigh in on that one? Okay, well, all right, so I think there's another.
I will just add one more comment. That
Yeah.
the majority of the claims that I am seeing in the commercial space, and again, that's my area, but the affordable housing where we end up in these lengthy dispute areas, matching is a big issue. That is where we get caught up, is either matching or the idea that the wind came through and circled and damaged the siding on all four sides of the house. So those are the two primary issues I've been seeing, and the involvement of public adjusters prolongs these disputes and pushes them into mediation, litigation issues.
Okay, well, I think we're good here. Do we want to bite off, do we have any other little ones we could chew up in a half hour? Or could we, because,
Well, Mr. Chair, you had mentioned, in addition to the
three that were listed.
in conjunction with this alternative dispute resolution, you had gone down, and I don't know if your intention had been to pick up 9.1 or address credit scores, and I'll just tell you from our standpoint, that is a, we are solidly opposed to any change. I mean, there is no more accurate prediction of risk than credit scores, and it's a critical tool for insurers to use.
Yeah, I think this is probably not the right forum to go down that one, but it doesn't mean it's going away. So, no. So, I mean, there is an existing provision in the data privacy law that I passed that if automated made a decision-making, if models are being used, whether it's related to employment or housing or insurance or healthcare, you have to be able to provide, let the consumer know what data was used in the analysis, and provide a plain English explanation of what are the factors and why did you get the decision that you did. And working with the AG's office on, possible enforcement about that. But just think about it in that context, is that you do need to be able to explain why the independent variables in the model make sense. And we'll continue to visit that one, but not necessarily in this forum. Let's see, what else? I thought there was one other little, because we could start talking about tort reform. We don't have that much time. I probably don't want us to go down that one till next time. What do you think?
Probably be better to save it for a
Yeah.
fall meeting.
Yeah. So I think we're good. So Austin, yeah, yeah, go ahead. Oh, yeah, that was it. Mhm. Yeah, so,
I feel like there's broad consensus from at least some of the conversations initially that we've had on this, that maybe that makes some sense on one thing that we could come around and potentially evaluate on these disaster savings accounts.
okay, so thank you for bringing that. That is the one I was thinking of. So whether it's, health savings accounts, the disaster savings account, who would take advantage of it? Because if you've got enough, I look at some of these things and they look at them mostly as, tax incentives for people like me. And given the size of a typical storm damage claim, you'd have to put away a significant amount of money to take a dent on this and tie it up for that specific purpose. And I wonder who would actually, would there actually be much uptake on this, and who would use it? I mean, I would consider myself a prime candidate for it, but I'm having trouble seeing the benefit myself. Would I want to sock away $5,000 or $10,000 and have it tied up in an investment account strictly on the chance the really small chance that any individual one of us would actually face that kind of a claim? Yep.
And Mr. Chair, I guess when I'd envisioned this program being stood up, given that there's so much structure in place already with regards to mortgages, people put their money in escrow for their property taxes, for their insurance premiums.
Okay.
I could see this riding along with this as when you're sitting down the budget, hey, how much can we come up with monthly for a mortgage payment, work backwards from there. I think part of that process would be saying, hey, this account exists, and hopefully on advice of your lender would just say, how much would you like to sock away a month in this special program? Call 150, call 200. I don't know what the number is, but I guess part of my thought was making that an automatic, part of your automatically monthly payment so that that money's sitting there so that when something does happen, you're looking at a deductible or something else, you can say, oh, wait a minute, I have this account set up in place and I have some money socked away that will help soften the blow of a deductible or some other expense you might incur. And so that was my thought, is that we already kind of have a system in place for that. Why can't this just be added on to that? And from a consumer standpoint, they would have a nice predictable payment that this would just be a part of. Essentially be saving, I mean, we should all be doing this ourselves anyways, but it would, providing some incentives that, that go along with it, I think would be good. Not sure the state's in a budgetary position to be able to offer something like that, but at least for the moment, can we set up or consider setting up the infrastructure, and then down the road, if we want to couple it with some sort of tax incentivization, I think that would be something maybe for a future legislature to consider.
So under what circumstances could you draw from that account?
Well, I think that's up partially to this task force and, for the most part, the legislature to determine, certainly insurance deductibles, but I would say even other things, maybe not new construction or maybe not remodeling. I'm sure Mr. Johnson has thoughts on this, but I would say, certainly your deductible, perhaps some other expenses would qualify. Again, from my perspective, I think the deductible usage would help soften that blow for homeowners when something happens. And so that would be, I guess, a starting point, but I'm certainly open to other ideas. Certainly if it's a new roof, if your roof has aged out, 15 years old, you want to use it for a new roof, I think that'd be a prudent usage of those dollars. Other things like that, I think that's fair game.
Yeah, that part I could see is basically a depreciation fund. So,
Mr.
Jean,
Chairman,
you
I
had-
would
yeah.
add that this is a great way to beef up the resilient materials side of things, that if someone gets a grant for $10,000, and we know that's not going to pay for the roof, but if they are able to use these tax-free dollars, if they are replacing with a resilient roof, that would hopefully encourage more uptake on that type of a program. So I would encourage us to include that in that.
Mr. Chairman, I think, there are some states that have already established state disaster disaster savings accounts. I think, we would be open to sort of exploring that. I think we really need our colleagues from the Department of Revenue to be part of that conversation, because sort of thinking about the tax implications and how that would translate to, from a state budget perspective, is really in their purview. So I think maybe engaging with them between now and the next meeting would be a good first step to sort of think about what the scope of a recommendation from the task force could look like. And I think, Jean, to your comments, and Adam, you as well, I think one other thing that we might want to think about connecting this to any recommendations related to trying to increase the number of fortified roofs through Strengthen Minnesota Homes is that we'd want to think about the tax implications of a grant to a consumer, because I think, at least from a federal perspective, they view that as income. And so there might be an opportunity for us to make any grants offered to a consumer through that program not taxable, at least under state tax law, but there would be cost implications, and the Department of Revenue could help us think through that as well too. So just tying those two ideas together.
Well, and the other tax part of that too, if we're talking about tax stuff, would be making upgraded fortified materials sales tax exempt.
Yeah.
As an incentive. I mean, it's not a huge dollar amount, but that would be something.
And I think, Mr. Chair, I'd be curious to hear from the common interest community folks and from the affordable housing providers, because my understanding of the states that have done catastrophe savings accounts are really sort of an individual person-by-person opportunity. But I think particularly for businesses or associations that have limited options for raising capital for big capital expenditures, could you sort of extrapolate this idea for a business to be able to pool, or businesses to be able to collectively pool resources that could be drawn on to be able to make building upgrades? So there may be some ideas to explore there on the business side, which to my knowledge, no state has really attempted to take this idea and apply it to that.
Yeah, the one aspect of this, or an aspect of this that kind of does appeal to me is that, we, speaking as a homeowner, we've come to almost assume that sometime over the life of our roof, we're going to be hit by a hailstorm and the insurance company is going to give us a new roof. I've been through that with State Farm myself. So, but if as a way to essentially depreciate your roof, so that we don't have to have that expectation that we have money put aside, when the roof wears out and needs to be replaced. I kind of like that part of the idea.
And I would just add, Mr. Chair, I do believe that there is a federal push to do something from a tax incentivization standpoint on something similar to this.
Yeah.
And so, again, if the state had something stood up in place that then Minnesotans could take advantage of
Yeah.
federally in the future, I think it's only for the benefit of consumers.
And I just support Mr. Brickway's comment on broadening this to the commercial side.
Yeah.
The very few clients in the affordable housing space that I have trouble placing, it's because they have existing damage and they do not have the funds to cover the deductible, so they have left the damage unrepaired. And the industry doesn't want to take on a property that has existing open damage. So that would help solve that problem, that set aside those funds. And, we can all say, well, we don't want to put those funds in an account, but emergency fund accounts are a budgeting mechanism for consumers and businesses that should be happening. And if it's not, this is a way to encourage it.
I would just say, on the nonprofit housing side, herein lies like one of the other issues, not facing insurance necessarily, but just a factor on their overall budgets and availability to get funding to do deferred maintenance. Properties often are funded for 15-year terms, and with the expectation they'll go in to apply for additional subsidy to do deferred maintenance and, kind of fix up those things, replenish their operating reserves. But we're at a point right now where, a lot of affordable housing providers, they've depleted their reserves. They've been applying to try secure additional funding, but they are unable to do so. We have limited funds there too. And they are already nonprofits, majority of them, all my members are anyway, so they wouldn't be able to benefit from additional tax write-off. So I am not opposed to this. I just am is this where we could have the greatest return on investment? If it means there's less claims, which overall contributes to, the overall market, then yeah, I'm interested. I just wanted to explore whether or not this is the best use of funds for the state to get the best return on investment. But I'm not opposed to it. I just wanted to chime in on the affordable housing side that.
Yeah. Josh, do homeowners association pay taxes?
They do not, no. I mean, taxes on, interest on investments, but that's it. I'll dovetail what Carrie was saying from the HOA side, though, and that was my earlier question of, are we seeing a correlation with premiums right? Makes sense. From the HOA side, I struggle with the idea because it's hard enough to get homeowners associations to adequately fund their reserves as it is. So if you're going to increase an expense of a more expensive shingle, for example, how can that be ROI'd to say that, yeah, but premiums have gone down and there's incentive programs to do it, to offset some of the cost increases? That needs to kind of be reconciled, and that'd be, something that would have to be sold to HOAs, right?
Yeah. Okay. All right, so does anybody have a homework assignment on this one? I don't.
Yeah, I think revenue's input on getting some type of what the fiscal note on this would be, or revenue note, I guess, is gonna.
Well, Mr. Chair, I mean, I'm happy to call our friends at the Department of Revenue. I wonder if this is something that maybe lends itself to sort of a recommendation about studying it, rather than like, the legislature should pass it or something like that. But yeah, we could start with revenue and bring them into the conversation.
Yeah, Mr. Chair, I would just add, I don't know how revenue would even begin to derive an estimate of how much this program would cost. You have no idea what kind of uptake you're going to get from the public. You have no idea, as far as, I don't even know what a maximum per year input into this account would possibly be. And so I'm sure revenue has people much smarter than me that could think through this stuff. But I do think any estimate is going to be
Yeah, so
somewhat
is this something we just want to have a general recommendation that we study it?
Well, yeah,
or-
because until we know what we're allowing as permitted expenses, there's probably not a way to accurately determine what because if you say just deductible, that's one thing, because you're gonna limit the amount of money going into it. But if you open it up to maintenance or damage that you're not submitting in lieu of, in lieu of insurance, that broadens it a little bit too. Probably makes it a little more useful.
Yeah, so in this one, we'll just put in a recommendation that this deserves further study. It seems to be only mildly nodding heads, but I think we're kind of stumped on what we might want to do immediate term on this.
Mr. Chair, again, I think one of the asks of revenue is maybe to be able to provide some technical assistance on how this, how people would go about setting up, or how legislatures would go about setting up this program. What does it entail? I don't think it's an exact model like an HSA that you can say, it's an HSA, for home maintenance or for home, disaster, whatever we name it. But I do think revenue could perhaps provide some guidance on, what the legislature would need to consider when setting something like this up. And so, I just to add to Department of Revenue's homework, since they're not at the table at the moment, I think that'd be something that we'd want to ask them as well.
Yeah, I can take it on to reach out to the Department of Revenue, but I'm going to give you the homework assignment to describe it with what I'm going to go to Revenue and ask for.
So am I the kid in the partnership in the science classroom that does all the work for the presentation? You just put your name on it?
We're spreading the wealth.
Sounds good, Mr. Chair.
Okay. Okay. Well, I think we've had a productive afternoon. So Austin is going to summarize a bunch of this stuff and circulate it before our next week meeting. And we will have dueling tort reforms at the next meeting. And yeah, I'm really pleased with the progress we've been making on this in this group. So this has been a good group. I'm doing 4 of these this off session, and this has been probably about the most productive one. Good. Okay, I think we can be adjourned if there's no further business. We're adjourned.